It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and we have some exciting news today. I have a big announcement. We have a new bank, and we have a new bank with a lower interest rate and higher access for those with good credit scores. What do I mean by this? Remember, anybody who's been listening to the Your Personal Bank Show for a while understands this concept is two-step. It's based on, we set up a high cash value policy designed to maximize cash growth. We have companies that have been paying 6% dividends or more every year for the past 25 years plus and have never missed a dividend since literally before the Civil War. So that's powerful. So the idea, again, is not to purchase insurance in the traditional sense of the word, how most people view and use insurance. It's more about maximizing growth, maximizing dividends, making your money grow on a tax-favored basis, and grow your money income tax-free, access it tax-free, and pass it on to your heirs tax-free. Again, if it's set up properly, which, of course, we do that, obviously. So again, it's about growing your money. Then the second step, of course, is we set up a bank line of credit using the cash in the policy as collateral for the loan. It's really quite simple. And the lower the rate you can get, the more positive arbitrage you can earn. So the question I ask all the time for folks is quite simple. I say, look, if your money's growing, let's say between 5.75, 6% dividends, okay? If you leave it there in the policy, that's what you're going to get. You're going to get that kind of growth. It's pretty straightforward. But if you access the money and you access it through the bank line of credit and they charge you 3.25% interest, what's your money doing? Well, the answer is quite obvious. You're still making money. You're keeping the difference. And the difference on 5.75 minus 3.25 is 2.5%. So in other words, you still earn 2.5%. And folks, here's the key. Don't miss this. This is the big takeaway, okay? This is the true power of the Your Personal Bank concept. And that is quite simple. It's this. That 2.5% positive arbitrage, that difference you get to keep is on money you spent. I'm going to say that again. The difference, the 2.5% positive arbitrage, based on a 5.7, we're going to get you that at least, okay? That's what we can have available today in terms of dividends. And then you access it and you get the 3.25, which is the rate we can get now. For most people, we can get it down to 3 in certain situations. So you're going to be like 3.25 in most situations. Worst case scenario, 3.95. That'd be for much smaller accounts potentially. But generally speaking, most clients that we work with are going to be in that 3 to 3.25% range. If you're getting 5.75 dividends, at least, and you're getting charged 3.25% interest when you access the funds, at worst, that's 2.5% difference. That's what you get to keep. That's the positive arbitrage. And like I said earlier, the big key is, the big takeaway is that's on money you spent. That's on money you used elsewhere. You allocated it to invest in other things. You spent it on things. You paid down debt. Whatever you did. That's what you're keeping, the difference. Now, why is this so powerful? Look, do you know how to earn interest on money you've spent? I sure have not found a way to do that. And if somebody knows of another way, folks, I've been on the radio now for a couple of years. I've been speaking on this concept to investor groups for, going on 7-8 years now. And here's the thing. I've brought this out. I've challenged people. No one to this day has brought a method for me to earn interest on money I spent other than the personal bank concept. So what I'm trying to say is this. If you get one takeaway from everything I'm sharing with you today on this show, and frankly, any show that you listen to, the one takeaway I want you to get from this is not only do you get positive arbitrage on the money, on the difference, that you keep the difference, but it's on money you spent or allocated elsewhere. Normally speaking, typically, if you spend money, you take money out of an account and you spend those dollars, or you reallocate those dollars to another investment, whatever, those dollars are gone, aren't they? They're gone forever. You never earn interest on them again the rest of your life. Now, some people, occasionally, I'll get someone who will kind of poo-poo that and say, well, 2.5%, that's not all that lot. Folks, first of all, 2.5%, that's every single year, the rest of your life. Okay, so think about compound interest. Without compounding in a decade, that's 25% more money. Hey, I think almost anyone would agree having an extra 25% money on funds I spent. It's, again, not money you would have any other way. Would that make a difference? Would it help? Would it be beneficial? See, the answer is obvious, isn't it? And see, that really drives the key point to why people, when they're looking this, when they miss the point, I'll put it this way, when they miss it, when they don't get it, what they're doing oftentimes, most often I find, is they're trying to compare the rate of return on this versus another investment. And I tell them, wait, whoa, stop a minute. You're looking at this all wrong. This is not, should I do this investment versus another? That's a big mistake. Huge. Don't make that mistake. That's what I'm encouraging you to do. Don't make that mistake that sometimes gets made. And this mistake, again, is quite simple. They're trying to compare this versus that, this investment versus that investment. Look, here's what I'm going to say. I sound like a broken record with clients and folks I work with. It's this. Look, you have a choice. If you have some dollars you want to invest into something, you have a choice. You can take those dollars and invest them, of course. Or you can take those dollars, put them in a personal bank policy, access them through the bank line of credit, and then take the dollars and invest in whatever it is you wanted. What happens? Well, you're going to pick up another 2.5%, almost 3% positive arbitrage, depending on the situation. Why is that such a big deal? Well, what if your investment gets you a 7% rate of return, for example? Let's say you average 7% on whatever your investment happens to be. Well, what if adding another 2.5%, 3% to that? Would that make a difference? In other words, instead of making 7, you're now making 9.5 or 10, aren't you? Is that a significant difference on your rate of return? Just about anyone would agree with that. Even if your average rate of return happens to be 10%, I mean, that's pretty strong. Most people would agree. I'm talking about average, not 1 year, not 2 years. I'm talking over a long period of time. Getting 10%, that's strong. After tax, don't forget that part. Add 2.5%, 3% to that. So now instead of making 10% rate of return, you're making 12.5 or 13. Are we talking about a difference here? Yes, we're talking about a 25, 30% difference, additional increase on your returns. Take a business, for example. Anybody who's ever owned or dealt with a business or understands numbers, add 25 to 30% top line profit to that business. What would that do to just about any business out there? It would dramatically change the financial picture, wouldn't it? See, your personal bank is way more powerful than most people realize. Now, people that use it, and once they start using it, start to realize how powerful it is. And by the way, going back to our announcement of a new bank, that's exciting because by bringing another bank into the fold, we have several we work with, but now bringing another one into the fold that offers an even lower rate than most of the others, 3.25%. So again, you're earning 5.75 to 6% dividends today, 2021, okay, even with the low interest rate environment we're in, tax-free with guarantees, okay? I think most people agree that's pretty strong. With a long history of doing that, 25-plus year history, I'll show you, of all the top dividend payers, never missing a dividend since before the Civil War. We're literally looking at 5.75 to 6% dividends. Then we can access those through the bank line of credit and get charged 3.25% for that, maybe even as low as 3%, depending on the situation. But with the 3.25% bank here, there's one other little caveat here that's exciting. This is unique. I've never seen this with any other bank in the country. And that is, they'll allow you access 100% of the cash value in the policy. Folks, that's huge. Again, I'm going to say it again. even for longtime clients of mine who are going to listen to this show. They're going to reach out to me, and I'm going to encourage you to do so. Contact me at yourpersonalbank.com, or you can send me an email at ference@yourpersonalbank.com. It's FERENC. It's my email at yourpersonalbank.com. I'll send you the information, the application, all that good stuff. 100%, this has not been available before, 100% of the cash value available in the policy, as long as you have good credit, 750 or above. Okay? So if those of you that have good credit scores and want to use and access your dollars and pick up positive arbitrage on 100% of the cash value in the policy, we can now do it. This has not been available up until today. So this is exciting, super exciting news as of today. We're going to be sending information out to everybody. We're going to be emailing all our clients. I'm going to be real busy for a while. I know that for sure, but that's okay. Because here's the thing. We're putting our clients in a better position than they were in even before, a better position than they were even last week. Hey, what they were doing last week was good, but it's even better now. And by the way, it's kind of fun. I've been calling people all day, clients all day, notifying them, hey, let them know, hey, great news. We got a new bank, lower rate, more access, 3.25% interest, 100% access to the cash value. 100% of them are excited. Every single client I've talked to, like, that's awesome news. That's great. Send me the info. And folks, this is a one-page application. They'll process it within about 5 days, the bank says. They've got a real streamlined process. They will pull a credit report, like I said, and that'll determine. Now, what if you're below the 750? Okay, if you're 620 to 750, they'll give you 95%. Okay, that is not bad. So 95% of the cash value available with your line. If you're over 750, they're going to give you the 100%. That's awesome. That's unique. That's the best available in the country. And we're excited to announce it here with yourpersonalbank.com. So again, contact us here for more information on that. All I'm saying is I'm super excited because everything I've been sharing for this on the radio for the last couple of years and for 7 or 8 years prior to that, speaking and sharing with clients, it's just gotten better, folks. And it's fun when things get even better than they were before, and they were working really well before, okay? So stay tuned. I'm going to talk more about the new new option available with the better interest rate, the lower rate, higher access. We're going to talk more about that in the next segment. And I'm also going to talk, I've had a really fun week, and I've met with a number of really interesting folks who are all happen to be either new clients or clients that are adding additional policies, additional personal bank policies. So stay tuned. Don't miss it. It's going to be exciting.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and we have exciting news today. As I stated in the first segment, we have a new bank with a lower interest rate and more access to funds for those with good credit. What are the details? Quite simple. Again, we set up a high-value policy, high-value cash policy to grow dividends. And we have companies that have been paying 6% dividends every single year for the last 25 years plus. The best companies are paying between 5.75%, 6% dividends today. And I can share with you which companies, why, and all that good stuff to grow your money, access the money, grow it, access it tax-free, and create positive arbitrage through the bank line of credit. We access the funds through a bank line. The cash in the policy is used as collateral for the loan. So it's a collateralized loan. Super easy to qualify for. But the higher your credit score, the more access you have. So the rate right now is 3.25%. For most people, it's going to be 3.25%. If you're earning 6% or 5.75 dividends and you get charged 3.25% when you access the funds, you're picking up the difference, or 2.5% to 2.75% positive arbitrage, folks. Okay, that's awesome. Now, that's on money you spent. Like I said in the last segment, the key to this, the takeaway, do not ever forget this. The positive arbitrage, hey, if you leave the money there, it's going to grow 5.75%, 6% dividends with guarantees, okay, tax-free, long-term, good, solid growth, okay? Particularly in this interest rate environment. Historically, by the way, prior to 0809, these policies were paying 7 and 8% dividends. So we're on the low end of that scale because of the low interest rates. But even at this interest rate environment, you can still get upwards of 6%, okay? Long-term history of doing that. And with higher interest rates in the future, most likely, which is what a lot of people are concerned about, and they should, 7, 8 is more normal in a normal interest rate environment. And in high interest rate environments, we've seen double-digit dividends with these policies, okay? It's all relative. But my point is today, in our current environment, 5.75 to 6% dividends is what you can get today with guarantees, tax-free, all of that. Then if you leave it there, that's what you get. If you access the money for whatever reason, then we encourage you to recommend accessing it through a bank line of credit. They're going to charge you 3.25% in most cases, and you keep the difference. But not only that, you keep the difference on money that you spent. Remember, these are dollars you've accessed and used and taken elsewhere, right? That's the key point. That's what I want folks to understand if they understand nothing else. Again, you're earning interest on dollars you spent. Where else can you do that? I'm not aware of any place else you can do that. And if somebody does know, please inform me. And no one has done so for years, okay? So this is a powerful tool. But not only that, we're excited about the new bank with the lower interest rate, which is always fun because that's bigger positive arbitrage, right? Secondly, for those with good credit scores, and that's folks with 750 and higher, they will normally these bank lines, you can access 95% of the cash value. So remember, the policy, we're maximizing cash value day one. Okay, so that's one thing you need to understand. Let me back up one sec. A lot of people misunderstand or don't realize because they're familiar with more traditional insurance policies and how they work. And traditional policies typically take a decade or more to grow cash value because the first few years typically is geared primarily towards death benefit protection. So a lot of the cash is eaten up by that to cover that higher death benefit protection. Okay? Many policies that are set up traditionally, not like what we're doing with Personal Bank, but traditional use of insurance policies, I'll look at them and the cash values many times will be zero even the first 2, 3, 4 years even. And the reason is quite simple. That is policy that's geared towards much more towards death benefit than cash value. I always say put death benefit and cash value on a teeter-totter. Cash value on one side, death benefit on the other. And depending on how that teeter-totter is adjusted and what the needs of the client are, determine how much death benefit versus cash value there is. Most of the time when I meet with folks and I ask them what their goals are, what they're trying to accomplish, but most of the time the answer is they want to maximize cash value. Therefore, we're minimizing death benefit. And by the way, folks, we're minimizing death benefit from anywhere from 50 to 85% right out the gate, first year and every year. What does that mean? When you're looking at a cash value in a policy, and like I said, I looked at one, dealing with one today where they were looking at putting in $100,000. They had over $86,000 cash day one available. Folks, that's a whole lot bigger than zero, isn't it? That isn't a small difference. That's a massive difference. That's how we're structuring these policies, okay? Now, we can do them with you front load them like I was talking about there where you put most of the money up front and add a little bit subsequent years and a few years 2 through 5, but most of the money's going up front. Or you can fund them over a period of time, over a number of years. And by doing that, okay, you can fund them over a number of years, okay, and the bottom line is it's really quite simple. If you fund them over a number of years, we can look at liquidity anywhere from 50, 60% on up, depending on the situation, age, health, all that good stuff. My point is simple. If we're looking at 50 to 85% more cash available day one, that's a whole lot more than zero, isn't it? Like a whole massive amount difference. When I show the numbers to people, and it's quite interesting, I show them the difference of what a traditional policy looks like versus how we structure them, maximizing the cash value. There's no comparison. Eyes are opened. People are surprised, pleasantly surprised, shocked even. They had, like, many times they're like, I had no idea you could do this. I had no idea this was the type of thing was even available or could be done. Now, I hear that from not only from clients or potential clients, I hear that from insurance agents, financial advisors, CPAs, attorneys, you name it. Very few people, in my experience, have ever looked at or seen a policy structured like this. That's just the facts. So I encourage you to contact me at yourpersonalbank.com to see the massive, significant difference in cash values we're talking about versus what most people are familiar with. But on top of that, what makes your personal bank concept fairly unique, and I'm not saying nobody else out there is doing this, where they're bringing the bank lines, is I've never met anybody else doing it, okay? Now, I know it's done because the banks are doing it. The banks are offering these lines to people. I don't know if the people are finding them individually or people are recommending it. I don't know the situation. And they're doing hundreds of millions of dollars of these loans, so it's being done. I can tell you most of the time it's being done in the higher end, higher net worth individuals, businesses, trust-owned policies, things like that. That's where the majority of a lot of this type of financial structuring is happening, okay? Bank board, things like that, okay? But I'm kind of divesting here a minute. The point is quite simple. The facts that you can access the money, earn a dividend that's higher than what it costs when you access the funds, you get to keep the difference, and you get to keep the difference on the money that's spent. But not only that, you have access to 95% of the cash value in most cases. That's true in most cases. But then on top of that, okay, here's the exciting part. For those with higher 750 credit scores or above, you can access 100% of the cash value for your line. Contact me at yourpersonalbank.com for more information, and stay tuned in the next segment because we're going to talk about this further and some folks I've talked to just this past week.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and again, we have exciting news today. If you missed in the first segments, we have a new bank with lower interest rates and 100% access to the cash value in your bank line. Now, what does this all mean? It means more positive arbitrage. It means you get to keep more of your money when you actually spend it for other things. What does that mean? Look, if you haven't been listening to Your Personal Bank Show, or if you've been listening, you know what that means. If you're a client, you know what that means. If you don't, go to yourpersonalbank.com, listen to any of the previous shows. You can go to any of them and learn more about how this works. And the bottom line is we're setting up a high cash value policy designed to maximize cash growth, maximize dividends. We got companies paying 5.75 to 6% dividends today. Have been doing so every year for the last 25 years plus. That's tax-free if we set up properly, which we do. Long-term, with guarantees, you're growing your money. That's the point. And then we're maximize that cash, so you're having anywhere from 50 to 85% of your money available day one. Then we set up a bank line of credit to access the funds. The cash in the policies uses collateral for the loan, and you can have access of 95% of the cash. In most cases, if your credit is above 750, 100%. That is new. That is exciting. So we got the lower interest rate of 3.25%. With the dividends of 5.75 to 6, so you're looking at 2.5 to 2.75 positive arbitrage. Now, there are some certain situations on some cases where we can even get 3% rate, just so you know. So we can get as much as 3% positive arbitrage depending on the situation. So you're looking at, frankly, in most scenarios, 2.5 to 3% positive arbitrage on money you spent. Folks, that's on money you use and spent. That is exciting. That is the number one reason people contact me. And actually, that's what makes Your Personal Bank different. You actually gain some control of your money. You actually get control and use and access and interest on money you spent, even after it's out the door, after you spent it. That doesn't happen elsewhere. Other accounts, other financial tools that are used once the money's spent, it's gone, right? Here it's not. You actually still earn some interest. And that's why literally this past week is a perfect example. I'm going to share with you just some of the clients, I'm going to not share any details, but but the folks that are listening, they're going to recognize themselves. This past week, I've met with a CPA who's funding this for his family personally, so that he can have some more money eventually for a supplement retirement. And he has some special needs kids, and he wants to make sure that they're taken care of, even if something happens to him or after he's gone. I mean, that's powerful, okay? In your personal bank, as a CPA, he's determined this is one of the best ways to accomplish that. And he's analyzed this as any good financial CPA would do, okay? I'm a real estate investor. In fact, I interviewed one of them, Gary McDermott, a couple of weeks ago. He was a retired naval officer, engineer, nuclear engineer, actually, and then now real estate investor. Very analytical, very sharp guy who has not only set this up, he's doing more of them, okay? Because he understands positive arbitrage. A lot of entrepreneurs, business owners, real estate investors understand positive arbitrage. So do bankers, and that's another client. The couple, the husband is a bank executive, and he's funding this. Met with him just this week, a new client. We're in the process of getting their case approved and all. But they see the positive arbitrage. The bank exec, he understands positive arbitrage. He's a banker, for gosh sake, right? Why wouldn't you pick up positive arbitrage if you could? And that was his whole point. And he's excited about this. Okay, it's just a no-brainer, right? That's pretty much the statements. I just met with a retired couple, really neat, both of them in their 70s, and they're wanting to supplement their income. Retirement, they just sold a house, and they have some money they want to use to invest and generate income, and they're both in their mid-70s. And people say, well, a lot of people that contact me think, well, I'm too old. Well, guess what? We submitted it. The numbers look good. We're waiting for approvals. It's looking favorable. I have actually approved folks up to age 79 successfully on this, okay? But here's the point. They were looking at an annuity. They actually almost funded an annuity and changed their mind. And I showed them the numbers. I actually was able to show them a better annuity than the one they were looking at. But once the husband, for example, was listening to the radio show, and he said, wait a minute, why am I funding this annuity when I see where this could even be better? Because, look, and annuities, they're good financial tools. I know some people knock them because of the liquidity issues. I understand that. But for someone who's looking for a guaranteed type of income or they want to eliminate market risk, annuities can be a very good tool. And I've sold annuities for over 20 years in my career, okay? I've worked with clients when it makes sense, okay? And oftentimes it does. But your personal bank, in many ways, is far superior to the annuity. And since I'm running out of time in this segment, stay tuned to the next, and I'll share with the very reasons why this retired couple decided to go this direction versus the annuity. So stay tuned.
For more information on your personal bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. We're wrapping this up today, and we have exciting news, as you've heard already if you were listening to the previous segments, and that is we have a new bank with lower interest rate, 3.25%, and more access. 100% of the cash value of the policy is available in your bank line if your credit score is 750 or higher. If it's below that, it's 95%. That's still good. That's what we've had available before. But it can be up to 100%. So in other words, 100% of your money can be available if you got a good credit. That is exciting, folks. And for every client that I've shared this information with, they are very excited. And we're submitting the applications. There's no cost. There's no fees. There's no anything. They only charge interest when you actually access the funds. Remember, the cash and the policy is the collateral for the loan. If you missed all this, go to yourpersonalbank.com, go to our website, listen to the previous shows. How does your personal bank work? I've got about a year's worth of shows that are there you can listen to anytime you want. Pass it on. Strongly encourage you to do so. This is a positive arbitrage scenario where you can actually earn interest on money you spent or invest it elsewhere. What does that mean? You can pick up 2.5% to 3% positive arbitrage on money that goes out the door, that you spend, pay bills with, or invest in other things, which means you can pick up an extra 2.5%, 3% return on investments. Folks, if you can add another 2.5% to 3% to your average rate of return with guarantees and tax-free, why wouldn't you do that? See, that would be the real question. I'm encouraging and challenging folks on this. Why wouldn't you look at this? See, here's what I'm going to say. Get your preconceived notions out of the way. I know, and I know that may sound strong. It may sound a bit harsh. I don't mean it that way. But the challenge I have run into with a lot of folks is simple. When we explain that we use insurance as the tool to fund this, to create the cash, to create the dividends, some people have a preconceived notion or a limited view on what insurance can really do. And they haven't looked at the full aspect, the full gamut of what can be done. Those that do are in most cases typically pleasantly surprised and sometimes even shocked. They had no idea that this could be done. I mean, really, think about this a minute. Forget everything you've heard about insurance for a minute. Why would banks, corporate finance boards, wealthy families and individuals, why would they use this tool and have been using this tool by the billions, hundreds of billions of dollars a year? There's a whole category of insurance called BOLI, bank-owned life insurance, and COLI, corporate-owned life insurance. Folks, these are smart people. These are smart, savvy folks, financially savvy people. Bankers certainly understand money. I think most of us would agree. Why would they buy this literally by the truckload? You've got to ask yourself that a minute and realize, you know what, maybe there's more to this than I thought. Or what I would say is this. Maybe you looked into this. And I'm going to venture to say in most cases, you probably talked to if you met with an agent, you probably talked to somebody who had some level of knowledge if they were trying to maximize cash value, which is highly unusual in our industry. Most insurance is sold as death benefit protection only, buy a term, invest the rest. We've all heard that. We've heard that mantra. I want you to understand something, folks. Statistically, in most cases, that does not work and has not worked for decades. We have the statistics and the numbers to show it and prove it. The key is this. If you can earn interest on money you spend or invest elsewhere, why wouldn't you look into that? Really? I mean, come on. Let's be just direct and honest about this. Why not? You've got nothing to lose. And you might just learn something. You might realize, there's a whole lot more to this than I ever thought. There just is. And so few people out there specialize in this. This is very much an area of specialty. I've devoted the last 7 or 8 years of my career to this, basically. I started out as, in the IRA, 401k, annuity world, doing all the retirement planning, all the stuff that, most financial people do. Okay? But when I came to learn about this, and I realized the power here, and what could be accomplished, what could be done. The fact you could earn positive arbitrage, you can earn 2.5%, 3% now. With our new bank, with the new rates we have, we're super excited. It's even better than before. So if you haven't reached out to me, now's the time. I'm telling you. Why haven't you looked into it? I mean, if inflation comes into play, if taxes are higher, it doesn't make sense to grow some money tax-free. If inflation comes into becoming a bigger factor, does it make sense to have some money interest rate sensitive? In other words, the rate of return is sensitive to interest rates, which are typically higher and higher inflation, right? It's the time. If you haven't looked at this before, now's the time. Now, I'll just, I've been busier. I'm getting busier than ever because, a lot of people are concerned about higher interest rates and taxes and market risk, things like that. We can do that too, eliminate market risk. But again, the most important aspect, I got off track here a bit, but I wanted to go to this. Why not take a look at this as a diversification tool, reduced tax tool, positive arbitrage financial tool, earn interest on money you've spent. But here's another reason to look into this. And a lot of people have this misconception, just because you're older, you won't qualify for the life insurance and such. Folks, I just met with an older couple, retired couple, they're in their mid-70s. Okay, in Sun City. And they looked into research and had purchased an annuity recently. They actually just sent the funds in. Now, there's like a 30-day free look on these things, so you can cancel it, which they were able to do and get their money back because they heard about this show and what was going on, and they looked into it and quickly realized that your personal bank is far superior to an annuity for income generation or growth or reducing taxes in most cases. Here's why. Most people who have looked at annuities or understand this much about annuities. First of all, I always say there's two primary reasons for purchasing an annuity. Now, I get it. There's some people that have negative connotations to it. I understand that. In fact, back in my earlier career, sometimes I would share people all the aspects of what an annuity would do because I had a suspicion that they had a negative connotation. And then I would ask them a simple question. I say, annuity will accomplish this, this, and this. And it's basically, it can grow your money without market risk or generate guaranteed lifetime income. Basically, it's like creating a private pension check in essence, another check coming in every month guaranteed for the rest of your life. That's the main strengths of an annuity. And I would explain that to a lot of folks who were nearing or retired. And they would say to me sometimes, I don't want an annuity. I said, well, okay, well, how would you like to have an account that would grow tax deferred? You can access the money and create a guaranteed lifetime income if that was their goal. Or how would you like to grow your money based on index growth without downside market risk? And they're, we'd love that. I said, by the way, did you know that's an annuity? That's what an annuity does. And 9 times out of 10, they're like, really? I had no idea. It was eye-opening. So what I'm saying is there's a lot of noise out there that's been shared about various financial products, and probably annuities more than anything have been bashed or hammered on by the competition, but pulverized in many cases, just because it's a competitive product, okay, and they don't handle it or don't want to handle it or whatever, various reasons. And in many cases, it's a great fit for that client. See, my pet peeve has always been, look, you shouldn't have, as an advisor, you shouldn't not have a preference on products or companies for that matter. Your preference should be towards what's best for the client. What's the best fit? So again, annuity strengths are you can grow the money typically with an index strategy. You can maximize your growth without any downside risk. You have a cap, typically, upside potential up to a certain point, and then you don't lose on the bad year. So most index annuities will offer a double-digit return on good years, no loss on the bad years. Not a bad option for folks who are wanting to grow their money but minimize risk. Or annuities can have a guaranteed lifetime income. And many of them, even today, will offer a 7% roll-up rate. In other words, the money will grow 7% every year, guaranteed in a deferral. And then when you decide to turn on that income faucet, it'll turn on a certain amount of income per month the rest of your life, no matter how long you live. It's guaranteed. It's called guaranteed lifetime income. And look, if that's of importance to you or sounds interesting, annuities can be a great tool for that, okay? Forget the negative connotations or what you've heard about them. That's what they do, okay? And that's why billions of dollars of annuities are sold every year. Because people realize, wait a minute, this actually is a good thing and it works for me and it fits my needs, fits my goals, okay? And there should be nothing wrong with that. But here's why this couple that I met with realized that your personal bank is superior to the annuity in many ways. First of all, this one's simple and obvious. An annuity grows tax deferred. A life insurance policy grows tax deferred. Okay, that sounds the same. But when you access the funds from the annuity, you have to pay tax on the gains. If you access the funds through the policy properly, you can access the funds tax-free. Now, tax-free versus tax-deferred is better, right? I don't think anyone would argue with that. So that's obvious. The second one, this is probably the big one. The one big knock on annuities is the lack of liquidity. Most annuities out there only offer you access to 10% of the principal, or the money available, I should say, the account value per year. I shared with you in the earlier segment with your personal bank, when we set these up, you have access to 50 to 85% of your money day one. That's pretty darn good liquidity. With guarantees, when you're talking about a product with guarantees and to have that kind of liquidity, that's a tough combination to beat. In fact, I'm not aware of another one that has that kind of liquidity with guarantees. It just doesn't exist as far as I'm aware. So tremendous liquidity. So you can grow the money tax-free versus tax-deferred, or you access it tax-free versus tax-deferred, and you can have access to a tremendously high percentage, the majority of the money, day one, and usually within a few years, 100%, okay? So it's lots of liquidity, okay? The other thing is, built into these policies, of course, there's a life insurance component. Now, again, we're trying to maximize the cash and minimize the death benefit in most cases, but there still is one. And that death benefit can be very beneficial for particularly married couples or folks who want to make sure there's something for their loved ones in case something happens to them. With a married couple like this particular couple, a death benefit can mean it can replace lost Social Security income, for example. An annuity's not going to do that in most cases, but your personal bank will. The other big reason is long-term care. A lot of people are concerned about those costs and expenses, and some annuities have riders that can help offset some of those costs. But built into your personal bank policies, a portion of that death benefit is available for expenses related to long-term care. And, that can be significant. Much more than the amount of money is available in an annuity, frankly, and on a tax-free basis. So that's powerful. But the last one, which is probably the most important, the most powerful, is when you access funds from an annuity, or any other financial account for that matter, once you spent the money, it's gone, right? When you access money through using your personal bank policy, and you access it through the bank line of credit, you're still picking up 2.5% to 3% positive arbitrage. What does that mean? It means you're still earning interest on some of the money you spent. I'm sorry, you're earning some interest on the money you spent. Wait a minute. Doesn't that mean you're going to have more money? And the answer is yes. You're going to have more money available every year. Because if you're picking up interest on money you spent and you're using this money to supplement income, and you're picking up the positive arbitrage, that 2.5%, 3% positive arbitrage each year, you're going to have a whole lot more. And that's makes all the difference. See, when trying to generate income for retirement, isn't it all about, what's going to give me the biggest bang for my buck? If I contribute this amount of money, what's going to give me the most money to use, access, and spend over time? Isn't that the goal? The answer, of course, it is. And your personal bank accomplishes that far better than any annuity I'm aware of. So contact me at yourpersonalbank.com for more information. And as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.